The lurch from crisis to boom and back again never seems to end in banking. After a stretch overshadowed by bank failures big and small and the stresses of sky-high rates, the last few months saw a trading surge and even an incipient investment banking revival. This is all happening just as fresh regulatory burdens raise questions about peak regulation. A titanic election and an erratic interest rate path looms large. Still, there's enough room for diverging fortunes, the hangover of mega deals struck under duress, and some political jockeying by the bosses of Wall Street, all of which is the focus of this week's Viewsroom.
Welcome back to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with our fellow columnists about the biggest stories of the week. I'm your host, Jonathan Guilford.
And I'm Amy Donlan. We're now past the third quarter's earnings season for the biggest US and European banks. And despite concerns about the effects of rate cuts and the slow return of deal-making, each has some positive news to point to. Pretty much the whole peer group, save UBS, still digesting its acquisition of Credit Suisse, has outperformed the market. So, Jonathan, you're over in the US looking at Wall Street. What have been the highlights for you so far?
I think really what we're seeing is kind of an upturn in trading revenue, or I guess I should say sustained upturn in trading revenue. Some things never seem to have really changed after the pandemic. You've seen a lot of jockeying around in kind of the core bailiwick of investment banking. We've had some great kind of head-to-head comparisons between Goldman Sachs and Morgan Stanley, bringing everybody's favorite Wall Street rivalry back to the fore. But really, it's sort of, I guess, almost like a quarter to reposition what everybody thinks about how banks work through these different economic cycles. And I think on that note, it's a good moment to bring our guests in on the conversation who have been following this both from the point of view of results and also kind of the larger context of what's happening with regulation and beyond. So with us today, we have Liam Proud, associate editor and expert follower of banks on both sides of the Atlantic, and Peter Tao-Larsen, editor-in-chief of Breakingviews. Peter, Liam, welcome. So the biggest thing looming over this set of results, I think, is that we're now through the other side of rate increases, and everyone's looking to what will change and what will endure about the last couple of years when everybody was really getting to grips with the end of kind of a zero rate period for the first sustained time. How are the different banks grappling with that question, Liam?
Yeah, so I think that's the exact right way to describe the context. I mean, just to sum up, essentially what you've been able to do as a bank for the past couple of years is take 0% deposits and kind of do absolutely nothing and get 5% income off that. I mean, that's kind of gross oversimplification, but if you're a JP Morgan, if you're a Bank of America, you can take this customer money and you can just leave it at the Federal Reserve and you're earning this enormous gap. And that has really turbocharged, and this is on both sides of the Atlantic, this has really turbocharged their results. And you've seen all of the key kind of metrics of bank profitability have just been through the roof in the past couple of years. And the really interesting thing is that you've seen these kind of crazy revenue numbers at a time when the economy hasn't really kind of slowed down. So they haven't seen like loan defaults and all the kind of bad, scary, bad debt stuff. So the question now is, rates are going down. Do they start to lose some of that kind of juice from the top line? And the way I would sum up the results from the big Americans and the big Europeans is like, yeah, but it's not going to be as bad as you feared. So JP Morgan has probably been the most pessimistic in terms of its kind of signaling on this front. They've had Jamie Dimon, who's the CEO, chairman, and Dan Pinto, who's one of the kind of senior executives, have been constantly reminding the market this, this isn't going to last forever. It's going to be really quite, we are going to lose revenue here. But they kind of reluctantly reported this enormous revenue number in the quarter and had to sort of say, by the way, we've got more capital and we know what to do with. So I think JP Morgan's always a good kind of like figurehead for the industry and kind of being a little bit embarrassed about how high the revenue is and like kind of scratching their heads about why it's not going down quicker. I think that's kind of like the image to have in your head for the sector for this quarter.
And also, I mean, Peter, if I could bring you in here, because there are also businesses that, certainly on this side of the Atlantic in Europe, that are not boasting about how fantastic they're doing. Barclays Investment Bank is kind of off to a start, we'll say, in the reboot. But there are in Goldman Sachs Wealth Management, there are parts of businesses that that certainly don't seem to be doing that well. I was just curious, what are your thoughts on that in terms of how the CEOs are framing that, and whether there's like more room now for M&A?
Yeah, I mean, I think M&A between banks, with a few exceptions, UBS buying Credit Suisse is one. Kind of hasn't really been a thing for quite a while, and maybe we always talk about it. Maybe one of these days, some of this will actually happen. I know UniCredit's trying to buy Commerzbank in Germany, but it's kind of been the sort of the exception rather than the rule for a long time. Maybe it'll come back. I don't know. I think there are still underlying the things that Liam was talking about, right? There are still some fairly fundamental problems in a lot of banks, particularly in Europe. There's a lot of banks that are really struggling to earn a return that's above their cost of capital, and then kind of things happen along the way. I mean, we saw Deutsche Bank, for example, had a sudden increase in bad debts, which again is something that people have talked about a lot. It hasn't really happened to any great extent since the pandemic. And so when a little speed bump like that comes along, then it reminds everybody once again that, that the banks have ways of making money, but they also have many ways of losing money. And, and any quarter, one of those things can come along and kind of upset the apple cart.
Right. And I mean, like, I guess if I'm thinking about apple carts getting upset, right? I know this is maybe sort of a stateside focus here, but a big thing that has been looming over the group in the US is the potential finalization of Basel Endgame, which is the final set of rules to make good on the years-long Basel regulatory process. There's been a lot of back and forth about this. We had a kind of climb down from the Fed supervisory chair saying like, oh, look, we're going to go back and we're going to rewrite rules. Like, Peter, I know you've been taking the temperature in Washington recently. What's your read on what's happening here exactly?
Yeah, absolutely. First of all, I think it's very touching that there is this transatlantic divide between whether we talk about Basel or Basel. So, we can argue about that later. What the Swiss. And just to be clear, we're talking about the Swiss town, not the which is where bank rules get set, global bank rules get set. But yeah, I mean, I was in Washington last week, and there was quite a lot of discussion about this. As you say, you're right, Jonathan. The Fed is sort of one of the last big jurisdictions that kind of has to sort of finalize the final Basel rules, the final stretch from these rules this big overhaul rules that were started back in 2009. The Fed had proposed something. The banks pushed back very aggressively, lobbied like mad, took out ads on bus shelters in Washington, D.C. and things like that. And the Fed appeared to back down a bit, with basically saying they were going to propose something a bit more modest. But that still hasn't happened. And so one of the possibilities here, one of the suggestions here, is that some of the other regulatory agencies in the US are still a bit divided about what to do. Some people want to push ahead with the original plan. Some people want to go for something a bit softer. And it now looks, we're a week away from the US election. It now looks like this may well get pushed beyond the election. It'll certainly get pushed beyond the election. It may well get pushed into a new administration. And then it really becomes a question of like, well, who's in charge, right? Who's in the White House? Who's in Congress? Because that will then determine the sort of the framing of the people who get put in charge of the big regulatory agencies in the US. So you have a possibility where there's a real range of possibilities. There's a possibility where actually the regulators decide to stick with the tough rules, which will then prompt probably quite a strong response from the banks. They might even sue the Fed or something like that. But you could also have a situation where if Trump wins the election and puts a load of deregulators in charge, that they say, actually, you know what, we're not going to do this Basel stuff at all. We don't really want this global rule book. We'll do our own stuff. And so you had a bunch of regulators in Washington last week who were warning about, well, you could have a fragmentation of the regulatory system. You could have different regions going in different directions, and then potentially a race to the bottom. So there is a real concern there that at the last hurdle here, that this could all slightly fall apart.
It's funny. I'd be so curious to see some of those signs on the bus terminals, because if, as Liam said, you've got banks in some cases not really knowing what to do with all their capital, that they're making so much money. And the idea that somehow regulation is holding them back, I think is quite interesting. Liam, if I could just pull you in here on that, how do you square that circle if you're a bank explaining how regulation is somehow damaging your business?
Yeah, I mean, it's a really tricky and quite awkward one. I think if you're JP Morgan in particular, like Jamie Dimon has sort of done a lot of lobbying on this, and you'll see at kind of every kind of industry association kind of, conference, whatever, there's kind of, we shouldn't have to hold more capital. And then it's sort of like, now they don't know what to do with it all. The way I think about it is, I mean, it's not, I think sometimes we talk about capital as if it's like this like dead weight. It doesn't just like sit there, like it's, the way it's earnings in store, if you know what I mean. I think some people talk about capital as if it's like an asset on the balance sheet, which is sitting there not doing anything. It's not, it's a way you fund yourself. It's an absence of leverage. It's not like money sitting in a bank account that you can't touch somewhere. And I think it's just really important to kind of make that point when we're having this conversation about capital, because I think there's a way that bank CEOs want it to be framed, which is like not necessarily how it is. And it's quite interesting that someone like JP Morgan now saying, we've got all this capital, it's earnings in store. It's not, it's all there and it's kind of racking up but it's not dead weight. Like it's real stuff. It's going to produce something for us and shareholders one day. And then that's not how they talk about it when they're talking to regulators, which I find quite interesting.
Right. It's kind of funny though, because it feels like that framing that you're talking about, the kind of, oh, woe is us, we have this, big albatross kind of sitting around our businesses. It feels like it wins out a little bit, especially in conversations around endgame rules. It's really just been like a one-way ratchet on regulation ever since the crisis, right? It's been building and building, and we've had these bigger and bigger buffers built up to the point where now they are like, kind of reasonably decent buffers that are sitting on top of these businesses. And you have kind of a real turn in rhetoric from any sense of conciliatory tone, at least in the States. You had, I think, Jamie Dimon at a conference recently was kind of saying, like, now's the time to fight back. You have, Goldman on its earnings call was pretty unapologetically aggressive towards the rules. It seems like there's a feeling like, I don't know, have we almost kind of reached peak regulation here? Like, is the tide finally breaking and turning back?
I think we are approaching peak regulation. I mean, what we're talking about here, bear in mind, we're talking about the design of the final stage of the sort of the Basel process. Now that has to be agreed, and then it has to actually still be implemented, which will take several years. So even if this all goes to plan, there's still another few legs to go before they can actually plant the flag at the top of the mountain and say we've reached it. But I think what a couple of things are happening. One is no one's really talking about any new rules. I mean, we're talking about finalizing what's been done and trying to get it done as consistently on a global basis as possible, with the possibility that it might all still fall apart. Then you have, as you say, Jonathan, you've got the banks who have sort of realized that actually aggressively lobbying against rules can be quite effective. I think that's what the Basel process in the US taught us. And they're also getting a more sympathetic hearing from politicians. Right? The politicians have sort of bought the idea that there's a trade-off between growth and regulation. And the banks are basically saying, we're being strangled in rules regulation, and it's limiting our ability to lend to the economy, which will then deliver growth. And the politicians who a lot of them are sort of really trying to get things going in terms of growth are quite open to that idea. I mean, I think it's flawed, that idea, because I think ultimately, if you want to have growth, the most important thing to have is to have financial stability. And if you have financial crises every 10 years, that's the worst thing that can happen in terms of growth. So I think there's a danger to that, but I think we are definitely reaching a point where it's also, it's 15, 16 years after the crisis. People are, memories grow short. And I think, there is definitely a sense of like, okay, that's enough regulation for now. And, kind of let's not necessarily roll back what we've done so far, but let's not add anything more.
I think just as a point on that, there's a kind of because if the areas where risk is building up incrementally relative to where we were a year ago is not really in banks, right? Like you see So the thing that I'm borderline obsessed with is the fact that hedge fund leverage has just like gone through the roof. If you look at the aggregate figures, it's really quite dramatic, the amount of debt there's no like legal concept of a hedge fund that is like, they're not like kind of regulated as entities in the way that a bank is. It's not, no one's going around saying this is, how hedge funds are. And it's the same with kind of private credit, that they are regulated in kind of not in the way that a bank is. So I think we're reaching peak regulation in the sense that like the new incremental risky bits are not like entities that are really kind of lend themselves to supervisory regulation in the way that banks are. And I think that's part of the problem that we're seeing. And there's no appetite to introduce a legal framework. Here is a supervisory regulator for private credit. Here's a supervisory regulator for Citadel. You must do this. It's just not a thing.
Right. That's kind of a thread I want to tug on a little bit, because you look at kind of the actual details of Basel, right? And a big part of the controversy over in the US, I think, is these various changes to kind of like operational risk that end up effectively dinging what some of the banks thought was going to be their kind of slow and steady safety growers, right? So you have kind of fee income coming in, you have stuff that's more stable coming off of wealth management and so on. And all of that ends up getting kind of a more difficult treatment under the regulations. And you kind of wonder, like, do they maybe have a point on kind of the incentive set here? Like, is there a place beyond which you're simply pushing so much activity out into the shadow banking sector? So, do you trust kind of the folks at like Blackstone and Apollo and so on, and their kind of particular match of funding duration versus the credit creation they're doing? Like, do you trust them more than you trust the banks to be holding on to this kind of in the traditional financial system? I think there's maybe an argument for some of that, but like, do you think that there's a point at which the analytical frame turns, and we're not just talking about, oh, there is this potential time bomb sitting underneath a society or the economy, and it's the banking system, through to this is like one piece that interacts with all of this other machinery that's now running into the trillions of dollars?
A couple of things there. It's definitely, this shift Liam was talking about, sort of a risk out of the banking system. That is by design. If you talk to the regulators in 2009 who kind of basically designed the outlines of this rule, that was explicitly what they wanted to do, because they had realized in 2008 that having all this risk in the banking system was really, really dangerous. And when it went wrong, then taxpayers had to step in, and with all the consequences that we've seen. So it's intentional. I think there are two questions really. One is sort of, you talked about that sort of the idea of regulators looking at fee revenue and saying, well, this is operational risk, and we need to sort of somehow capture. We need to protect somehow against the possibility of that going wrong. And I think there is something to be said for the idea that banks turn loans into fee revenue, that they don't necessarily wash their hands of all the risk. So. But whether you can quantify that is a bit more tricky to say. What is undoubtedly true is that a lot of that risk has been pushed into non-banks, into the Blackstones and the BlackRocks and the Apollos and the hedge funds and various other things. And the sort of benign argument is to say, well, actually, that's better, because those are not systemic institutions, and when they go wrong, then some rich investors lose money and everybody else is okay. Of course, there will come a point where that is no longer the case, and we've already seen hints of it. Right, during COVID, the regulators had to step in and sort of and lend directly to kind of the capital markets in order to sort of stop the economy from freezing. And I think there is an expectation that will happen again. So how regulators deal with that issue is still a big question, and I think a looming question. And it's almost, I think, going to be a case that we're going to have another crisis where that becomes a problem for them to then kind of, for the whole game to start again, and the regulators to get cracking, roll up their sleeves, and then start figuring out how to deal with the risks in the non-bank sector.
And if I could, Liam, maybe ask you this question. So like the bigger picture here, in investment banking, it has changed so much by the rise of private credit and the tightening of regulation, shifts in the job market, tech luring away so many people. If we ever get back to like a normal on interest rates, whatever that means, what do you think the industry looks like? Where is it going?
Well, I mean, the expectation is that if rates kind of go down, then you should get more M&A, more leveraged finance, more IPOs, all of the things that bring fees. And as part of the way that these businesses are set up is that when, interest rates are when the big question in markets is where are interest rates going to be, and markets are very volatile, your trading businesses tend to do really well. And that tends to be moments when M&A is not happening because there's too much uncertainty. And then when the opposite is true, when kind of everyone knows what's going on, rates are kind of steady and there's not much volatility in the market, that's when corporates go out and buy things and private equity sell stuff and buy stuff. So you have this kind of like natural kind of up and down cycle. There's always been the way these businesses are supposed to work. So if you follow that logic through for the moment, we've seen a couple of years where there hasn't been as much M&A, as much kind of like leveraged buyout, as many IPOs as you saw in 2021. We've seen quite a lot of refinancing on the debt side. So that's been a bit different this year, but you haven't seen massive kind of leveraged finance, kind of fee generating stuff like we saw in 21. So if we settle at a lower, steadier interest rate level, then maybe the markets businesses don't make quite as much money. There's not as much spread out there in the market for sort of like buying and selling, securities for banks. But probably the investment bankers, the rainmakers, the IPO gods, these people end up making loads of money, which has not been the case. So, I mean, in theory, these businesses are hedged and they kind of go up and down and you end up kind of relatively similar. So that's the argument. I don't know if that'll happen.
Right. And I feel like kind of the thing that we're circling around here repeatedly is the way that the industry is changing and the way that the industry is kind of like fighting back or leaning into those changes. And the person who's really looms large for that, we've mentioned him a few times, is Jamie Dimon. You had him in the earlier part of the cycle talking about his rivals in the alternative asset universe dancing in the streets because of the regulatory push. You've had him really kind of like leading the tone on a lot of the response to where the regulatory path has gone. And JP Morgan itself, obviously like a huge kind of weather vane for how the industry is performing quarter to quarter. I mean, we have the election coming up. There's been this big kind of brouhaha about like, does Jamie Dimon endorse anyone? Like, who does he really think should be president, kind of secretly or in public or what have you? I mean, Peter, maybe this is for you since you've been doing the temperature check in Washington. Like, how do you think the election ends up playing into the bigger story of what's happening on Wall Street? Is this something where it's about a few set personalities like Dimon who are kind of there in the middle of the fray, or is there something kind of bigger going on here about Wall Street's relationship to Washington?
Well, look, I mean, first of all, everybody's being very careful not to endorse anyone, right? I mean, apart from people who really nailed their color to the mast, a lot of people are being quite cautious, and I think that is partly a concern that if Donald Trump wins, and they don't want to necessarily become a target for some sort of kind of future kind of grievance or something. Look, I think Wall Street is doing what it always does, which is sort of trying to adapt to the world as it is. I think I don't think anybody really knows what the result is going to be. I think there's a bit of a view in the markets that the second Trump administration would be like the first Trump administration, a bit chaotic, but probably lower taxes, higher deficit, kind of deregulation, etc. It's very hard to say whether that's actually really true or not. I mean, if you look at what Trump has actually promised in terms of tariffs, it would be very different. And obviously, I mean, the one thing, maybe one closing thought on this is just that, I mean, I was really struck by this in Washington last week, was how little anybody thinks anybody in Washington is going to do anything about the deficit, right? The US budget deficit is running at 6.5%, 7% of GDP this year. It's projected to be very high for the rest of the decade. That's before you get into like what happens in terms of taxes in a new administration. And there seems to be no real constraint on that. And so I do think, the one thing to sort of keep an eye on is there a point at which financial markets begin to say, okay, this government is borrowing too much money, the debt is getting out of control, and we need to be compensated for that. There's no very, very little sign of it at the moment, but if it were to happen, that would be a really big shock for everyone.
Well, Liam, Peter, fascinating stuff. Earnings season is over, but plenty to look at next week. I'm sure the banks will all be following the election closely to see what happens. And thanks so much for your time.
Thanks, guys.